My name is Jason Nagel. I'm the founder of 360 Wealth. We're a fee-based financial planning firm here in Calgary, Alberta. Our wheelhouse is working with physicians and business owners on holistic financial planning. And today we got a special guest, Tatenda Mawoyo. He works with GBL Associates, and we're going to be talking about IPPs, so individual pension plans. So Tatenda, thank you for joining us.
It's my pleasure. Thank you so much for having me, Jason. I appreciate it.
Yeah. So before we get started, Tatenda, maybe let us know a little bit about yourself and a little bit about GBL, the company that you work with.
Awesome. Happy to do that. So I'll start a little bit talking about GBL, then I'll go into a little bit of what my role is. So what GBL, what we do a few things, but in the context of what we're talking about today is we help to design and manage specialized retirement plans that aren't necessarily off the shelf. So what I mean by that is we have a massive income tax code in Canada, thousands of pages long, and there's certain things in there that are permissible for people to do, but they're not off the shelf, right? We can't necessarily walk into a bank or a branch and open or do these things like we could with an RRSP or a TFSA or what have you. So what GBL does is we exist to take these things that have typically been done with by larger corporations, by larger governments, and we make them accessible for business owners and incorporated professionals. Now, what my role is in terms of this sort of big machine is to do things like this. I kind of go out and I kind of, talk about these things, educate people on what they are, and I help enable them to take a look at them, to consider if this is something maybe they should look into doing for themselves as they look to save for retirement.
Okay, perfect. Well, and so today we're going to be talking about IPPs. So
Right.
maybe at a high level, can you just talk about what an IPP is?
Yeah. So, the best definition I can give that sort of balances not being technical, but also understandable is an IPP is a defined benefit pension plan that's specifically designed for business owners and incorporated professionals. Hopefully, a lot of us will be familiar with what defined benefit pension plans are. They've been phased out in a lot of industries, right? But we still see maybe a lot of government employees have the certain professions like teachers, for example. This pension plan that sort of promises a benefit in retirement. And so that's what an IPP is. But again, is designed specifically for business owners and incorporated professionals, giving them the opportunity to do these things or these structures for themselves, to their corporation. And really what the end result is, and I know we'll go through this in more detail, it's the point is to help these clients or these types of individuals tax shelter more of their money as they look to save for retirement. So again, it's a defined benefit pension plan that's designed more for business owners and incorporated professionals.
Okay. So let's narrow that down a little bit more. So who would an
Yeah.
IPP be ideal for? Like what type of client would maybe seek out this type of information?
Yeah, that's a great question. I'd probably look at maybe 4 to 5 criteria at a high level. Somebody's trying to see if this is, let's say, something worth looking into. The first thing is typically it's if somebody is a business owner or a professional, but they do their craft through a corporation, right? So this is somebody like think of a doctor or a dentist, but they have a professional corporation that they do their work through, or just a traditional business owner or business partner who owns at least 10% of the operating company. I guess you could put it that way. So that's all the first criteria. The second is in addition to being an owner of their corporation, which we typically call a shareholder, the idea is they're also an employee of their own corporation, right? So they pay themselves a salary. So that's very important because we're talking about tax deferrals and tax sheltering, similar to RRSPs, where somebody needs a salary to be able to get an RRSP benefit. This type of business owner or professional through their corporation would need to receive a salary so that they can access the IPP benefits as well. So business owner, professional, incorporated, salary component. The third, maybe a little surprising, is age actually comes into the mix a little bit. So typically we'll say somebody at least age 40 and upwards. And the main reason for that is once somebody does an IPP, they're not funding an RSP at the same time. You're sort of switching over, right? It's somebody saying, I'm going to do an IPP because this is going to work out better for me than just sticking with an RSP. And so what the age comes in is when somebody's younger than 40, they actually get more contribution room in an RSP compared to an IPP. So it just makes sense to use
Okay.
that, right? And then from 40 onwards is the earliest it makes sense to kind of consider that switch. The last thing I'd say is probably important to the mix. We say just a client with sort of healthy cash flow in their corporation. So what we mean by that is there's enough income that comes to the corp where they can pay their employees, pay themselves some salary, or they need to kind of put food on the table. and there's cash left on the table. There's extra cash flow. And so that's where you kind of start to consider, well, if I can maximize an RSP and I've got extra money laying around, maybe let me consider an IPP so I can tax shelter more of my money. So those are the four high level criteria where, it might be, I'd say it's worth at least taking a look into an IPP.
Okay. Yeah,
Yeah.
they obviously need to be able to fund it if they're going to do it.
Yeah.
So when saving for an IPP, how is this different than saving inside an RSP or saving inside a holding company, for example?
Right. Yeah. So there's a few. So I'll kind of tackle that in chunks. I'll look at the RSP first.
Hmm.
And I think the basic theme is when it comes to either of those strategies, RSP or saving in a corporation, there can be certain limitations that come that they begin to apply or that a client can hit up against. And so an IPP for the right person can offer some relief. So if I look at an RSP, RRSP, obviously the first thing is the contribution limits, right? It's the way CRA will calculate your RSP contribution room is it's always 18% of your salary up to a certain maximum is what somebody can put away. Where an IBP can help out is we deal with larger contribution amounts, right? So it's typically a higher percentage of your salary up to a higher maximum is what can be funded into an IPP. So just given the access to increased contribution room, that's obviously tax deductible, tax sheltered, tax deferred. And so what that means is that there's just more tax deferral that kind of comes into play. So that's really the main component. Some of the things that might be more icing on the cake is things like income splitting with a spouse. Typically with an RSP or RIF,
Hmm.
you can't really income split with a spouse before age 65. Obviously, the exception is if somebody puts money into a spouse or RSP intentionally.
Yeah.
But with an IPP, if somebody plans to retire early, they can actually income split with the spouse as early as age 55. So that's a nice benefit
Hmm.
to potentially have. The
Hmm.
last one I'll mention that I think is probably one of the more underrated benefits of an RIPP is this. If I have an RSP as I do, right? If my investments, let's say for whatever reason, underperform, the market has been the market, and I kind of come up to the conclusion that I need to put away more money to reach my goal.
Hmm.
I kind of have to start looking at other sources or other buckets that maybe aren't as efficient, like non-registered accounts, things like that. One of the benefits of an IPP is if the IPP underperforms a certain benchmark that CRA gives us, somebody actually has the option to put more money back into the IPP from the corporation to bring the IPP assets back to where maybe we want them to be. And those additional contributions are tax deductible. So that's a nice kind of option to have. I'd
Yeah.
say if I quickly go through comparing it to corporate savings, I maybe list two or three things there. One is if somebody's going to save in a corporation, obviously first a corporation has to pay tax or active income tax on the active
Hmm.
income coming in. Whereas with an IPP, it's funded from the corporation, but it's also tax deductible. So we're essentially pulling money out of a corporation on a pre-tax basis. So that's
Hmm.
one benefit. As somebody retains in an OpCo or HoldCo and invests in there, it's obviously tax exposed in terms of there is some taxation on the passive income.
Hmm.
The benefit of the IPP instead is that the growth is tax sheltered. We only pay taxes when you pull the money out in the retirement years. And number three would be creditor protection. For some professions, that could be a key need, right? In terms of if you retain in a corporate structure, there can be some exposure to creditors. Whereas with
Hmm.
an IPP, it comes with very strong creditor protection, both in bankruptcy and outside of bankruptcy as well.
Okay. No, that's good
Yeah.
information. So on death, what happens to an IPP? You have an individual, they've been funding an IPP for a while. Unfortunately, they pass away. We know what happens with RSPs. What
Yeah.
happens with an IPP?
Yeah. So a few things there. So because an IPP is, like I mentioned, a defined benefit pension plan, this is all governed by pension legislation. So the first key question is when somebody, an IPP member passes away, the first question is, do they have a surviving spouse? Right. If that's the case, then typically what we see happen is the money gets paid out of the IPP, whatever assets are left, and they get
Hmm.
transferred to a locked-in account for the surviving spouse. So like a lira or to a LIF is typically what we see. Another
Okay.
option would be if the business or the corporation that's been funded is going to stick around, the assets can remain in the IPP. And essentially, there's a survivor pension that's paid to the surviving spouse directly from the IPP account. So to say, there's a couple of options, and no a decision is made based on what's possible and what works out best for the client. Um, and what the other on the flip side is, well, what if there's no surviving spouse? In
Hmm.
that case, there's a couple of things. Typically, what most clients will do is they will name beneficiaries on the IPP. So it might be kids or children or grandchildren. And so how it works in that case is the money is paid out taxable at that point, similar to an RSP. But the key difference is the money is paid directly to the beneficiaries and they pay tax at their own marginal rates. Unlike an RSP that's obviously taxed on the final return. This kind of gives the option to maybe spread that income amongst multiple people, multiple beneficiaries, and they each pay tax on their own returns. So, which can obviously result in potentially more after-tax income going to the beneficiaries. If there's no named beneficiaries for whatever reason, then it's obviously going to go to the estate of the deceased and is taxable to the estate.
Okay.
Yeah.
Okay. No, that's good. There's a question that you and I talked about in the past that I just want to address here is what happens with an IPP if you have a business and you end up selling that business?
Right.
What happens then?
Yeah. So, no, thankfully, there's a couple of options. Before I guess directly answer your question, Jason, I'll kind of lay, I guess, quickly summarize the structure of the IPP. So, like I
Mhm.
mentioned, we're dealing with a business owner or a professional that's incorporated. So they have their corporation. So what's
Mhm.
really happening is this client is saying, right, I own this corporation, of course, but I'm also an employee of this corporation. So
Mhm.
I'm going to use my employer that I own to set up this IPP for myself as the employee. So there's sort of that employee relationship that forms the basis. Now, when a corporation is sold, typically what you're going to see is if there's new owners in the mix, they're typically not going to want to have an IPP on the books for the person who just left, right?
That's right.
Or
Yeah.
if it's an incorporated professional, typically we see dentists, they might do a share sale or what have you. Or let's say a corporation is being dissolved. All of a sudden you lose that corporation. So the IPP can't sort of float around by itself. It always has to have a corporation attached to it that's eligible. So now I'll go
Mhm.
to the two options. So the first option is that we can always wind up the IPP. So what happens there is there's an eligible maximum that can come from this IPP account and go to a locked-in RSP, so like a LIRA or to a LIF, right? So we
Mhm.
move over the maximum eligible. If there's any additional cash left in the IPP account after we move the maximum allowed, that gets paid to the client as a taxable lump sum. So that's kind of how the mechanics that would work.
Okay.
Another option is if a client has another corporation that they own, we could potentially look to move the IPP from this corporation that was just sold or wound up and move it to another corporation that the client has. Now, the only consideration is need to make sure that we do have that employer-employee relationship. So like at least a year of salary from this new corporation to the client so that the corporation is an eligible employer that can now hold this IPP on a go-forward basis.
Yeah, so that's important. If they have a holding company that has a bunch of investments,
Yeah.
they're going to have to speak with their accountant about whether they can get salaried income from there
Right.
or not. Right?
Exactly. Yeah. Yeah.
Yeah.
So one thing I
Okay.
will say is in practice, obviously, as hopefully the client does a good job and lets people like yourselves know that, hey, I'm looking to sell my business or what have
Yeah,
you.
for sure.
And then we start planning ahead, right? So we always do like illustrations or estimates to kind of say, hey, these are the different options. This is what the numbers look like. Maybe there isn't a taxable lump sum. And so you just wind up
Yeah.
and you move over to a lira. So that's where we kind of have those discussions and see what's the best route forward.
Yeah, for sure.
Yeah.
I know there is options. And so with an
Yeah.
IPP, maybe we should talk a little bit about the setup costs and the maintenance costs. I know people will have some questions on that. So how do you answer that?
Yeah, so I mean, obviously, I'll kind of mention how GBL does it. There's a lot of
Mhm.
similarities even amongst different, I guess, actuarial firms like ourselves. So most firms have adopted a flat fee model. Now, one thing I probably haven't mentioned, but I should, is a firm like GBL. What we do is we just help to set up these structures like IPPs, and we help to manage them in terms of the compliance and the administrative work. We're not involved in the management of the money that's funded into the plan. Right. So typically the work that we do is built directly to the client's corporation so that they can pay it and it's tax deductible. So most firms have a flat fee model for this service. So for example, our fees for a one member plan will start at $1,700 a year.
Mhm.
For any if there's additional members who are going to participate in the same plan, it's maybe an additional $500 per person as a rough guideline.
Okay.
And so typically that would kind of cover the documentation that would include all the annual filings and compliance work. Something I haven't mentioned as well is with IPPs, really the main objective is we can fund more into it than we can into an RSP based on the rules. But we do need a professional called an actuary who will actually kind of go into this IPP and do the calculations to say, you know what, over the next 3 years, how much can you actually put into this thing? And so there
Hmm.
needs to be an updated valuation report done once every 3 years to certify the contribution room and submit it to the CRA for their review and approval. And so that's something that's also baked into that sort of
Okay.
flat annual fee.
Okay. Okay.
Yeah.
No, that's good. So not
Hmm.
too onerous at all.
Hmm.
What I'm sure there's a lot of misconceptions floating around there about IPPs. What are some of those? What
Right.
are the top misconceptions that you hear?
Yeah. So yeah, I probably come across a few of them. There's maybe 3 to 4 that always come to mind and
Hmm.
always pop up anytime I have these discussions. Number one would be that IPPs are too costly. Um,
Hmm.
Now, one thing I say is obviously any cost has to be weighed against the benefit. And typically for the clients who introduce this, the IPPs will typically provide over their lifetime hundreds of thousands of dollars of extra contribution room compared to an RSP. So for most people, they'll kind of look at the fee that's also deductible and say it's not quite an issue.
Hmm.
But obviously, I'm not the one paying the fee, so obviously that's subjective. But that's
Yeah.
the feedback we get. Number two would be that individual pension plans are sort of very complicated. Now, if I'm being fair, it's there's different rules that kind of apply, like we've kind of discussed today. But I'd say that's why firms like GBL like exist, right? In terms
Hmm.
of we
Exactly.
try as much as possible to be a black box, where if the underlying rules have some level of complication, the experience doesn't have to be. Right. So we kind of, like I mentioned, we do the setup, we handle the correspondence with CRA, we do the evaluations, for IBPs, you actually have firms like GBL that are listed with the CRA as an authorized consultant. So what that means is
Mm.
it's not sort of we set up for you and you sort of ride off into the sunset to have to figure it out. We are alongside with you for the entire journey to make sure that it's a
Yeah.
smooth experience. So those would be the first two. The other one that I often come across is that it's, in addition to being complicated, it's just an administrative nightmare for clients and for their partners like financial planners and
Hmm.
accountants. Uh, like I've kind of already mentioned, that's why we exist, because
Yep.
we're taking care of all of that. The last one that I often come across is I mentioned that an IPP is a defined benefit pension plan. And so if we have any familiarity or if we have, we might have friends or family who have defined benefit pension plans. And what happens in most large plans is somebody kind of gets to an age, is typically around age 55, where
Hmm.
a defined benefit pension plan becomes really locked in, right? And the way it works is, the government might say, look, you can't wind up your plan, you can't take out your lump sum, you're sort of locked into taking this lifetime pension, right?
Yeah.
But that's not the case for business owners and for professionals. Is they always at any point, if for whatever reason their situations change, a company is sold, they can always choose to
Hmm.
wind up the IPP and again move over what they can to a locked-in account. If
Yep.
people want more flexibility in provinces like Alberta, I believe we can unlock up to 50% of that when we convert to a
Hmm.
lift to kind of increase the flexibility. So that option to wind up and I guess pull the plug on an IPP is something that's always available to clients. And so that's just nice to know.
Okay. Well, Tatenda,
Yeah.
that's all great information. So thank you for sharing that.
Yeah.
I've got one last question. So if anybody is interested in understanding if an IPP is the right fit for them, if they want to look at, investigating a little bit further, where do they go to do that?
Yeah, so a couple options. So like I mentioned for GBL, in really with how we work, we don't necessarily work directly with end clients. Let's say the business owners or professionals. We really do this in collaboration with their professional advisory team, like their accountants, financial planners, investment advisors.
Mhm.
So I'm a big fan of what happens at 360 Wealth. So I say if you're listening to this and you want to take a closer look, I strongly encourage anyone listening to reach out to Jason and their team. Just to say, hey, this sounds interesting, maybe it's worth a look. And I know we have, we work together where we kind of loop GBL in. And at that point, we kind of gather information from the client, age, salary levels, things of that nature. And the first thing we always do is prepare an illustration, which is more fun on a complimentary basis. And
Yeah.
really what the point of that is to say, if you were to do an IPP, beyond all the theory, this is how much you could actually fund in practice, right? And we at GBL, we are big fans that the decision to do an IPP should not be done in isolation, right? It needs to be done in consideration of, we use the term holistic, right? What do you have going on in your
Yeah.
life? What are your goals? What are your plans? Where are you at? How much flexibility do you need in retirement? So financial planners like yourselves, you guys are really obviously great at doing that, right? At looking beyond the IPP to see, does this actually make sense in the long term? right? So I say, reach out to Jason and the team. They'll kind of loop in GBL. We'll assist with the evaluation process and the consideration. And then from then on, obviously, it makes sense. Then we'd help with the implementation.
Perfect. Good. Well, that's good. Well, I appreciate the kind words. We do work well together. So thank
Yeah.
you. And if anybody is listening to this, if they want to see if an IPP is the right fit for them, if they're a business owner or a physician, happy to have a conversation with you. So Tatenda, thank you very much for joining us today. I really appreciate it.
Awesome. Thank you so much for having me, Jason. It's a real pleasure.
All right. You take care.
Okay. You as well. Bye-bye.